You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets, offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity, with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com. or visit northerntrust.com/capital markets. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the old network where we break down the interesting, sometimes scary, sometimes just intimidating world of options for you, the busy financial advisor. Maybe you want to add options to your clients' portfolios. Maybe you've already dipped your toes into those options waters, but you need a little help, a little assistance to keep the ball rolling. Either way, we're here for you. My name is Mark Longo from the aforementioned network, as well as, of course, from the newly reskinned, revitalized, revamped theoptionsinsider.com. If you haven't been there in a little while, check it out. A lot of great content coming your way over there on the website, as well as, of course, access to all of our fine programs there for your listening pleasure. And however you listen, either it's live or after the fact, make sure you hit us up with those questions, those comments, those insights. We do love to hear from you guys. And joining me on the old program, helping me hold down the advisor's option fort today. First, let's spin the wheel up. It's landed first, way out there on a little speck in the middle of the Atlantic, known as Puerto Rico, where we are joined once again by the director of risk and also the portfolio manager over there at Swan Global Investments, Mr. Chris Hausman. Mr. Risk Director, welcome back to the program, sir.
Hey, Mark, you're too kind. It's always good to be on.
And also joining me, we dial that up the Atlantic and into the coast, the east coast of the U.S. there, all the way, not to Maine, but to an adjacent state, to New Hampshire, where we are joined once again by Mr. Matt Ambertson, the founder and principal over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the show. You know, everywhere I go these days, I keep hearing whispers about ORATS. You guys have a lot of irons in the fire, sir.
Lots going on here, Mark. I need to get out to Chicago. I want to see your actual spinner that chooses which person to go to
It's
first.
We borrowed it from the old Life board game. You may be a little disappointed there. It also says you get a job, you have 3 children, all sorts of fun stuff there on the spinner. But we penciled in ORATS just for you. And we're also going to pencil in a little bit of what's breaking in the world of options. So without further ado, let's get to it with a little bit of the old buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody. Welcome to The Buzz. Like the man said, this is the portion of the show where we break down the buzz in the world of options and particularly how it pertains to you guys out there, the busy financial advisor, asset manager. Maybe you don't have time to attend all the big events and pay attention to the going-ons in the world of options. So we're here to do it for you. Let's start actually on the event side. I just saw both of you guys, it seems like not too long ago, down there in the, shall we say, warmer environs of Miami for the big options industry conference. I know, Matt, you were on a panel. You and I spoke officially on the record here on the network down at the conference as well. Chris, you were there more in an informal capacity, kind of checking out the event for Swan. I think correct me if I'm wrong, Chris, this may have been your first OIC, aka the Options Industry Conference. So maybe we'll start there. Certainly it's your first in quite a while. What were your thoughts on the event and any interesting takeaways from the world of options that you think really pertain to our audience here on the Advisors Options, sir?
Yes, it was my first OIC conference. So I thought it was very informative. I was kind of surprised that there weren't more buy-siders, if you will. I think Swan was the only representative from the option-based category in the Morningstar category, as I mentioned. So I think one of the interesting things that I took away really was some of the data that was being presented that, one of the things we've talked about on this show is this liquidity vacuum, if you will. And, they gave some good presentations of which, mentioning that, there are 1 million listed strikes with open interest only on 50% of them. And the reality is only 10% of those strikes are actively traded. So, the other things that we've kind of talked about here on this show as well are market makers need reduced capital constraints so they can kind of free up and then trade a little bit more. And there was definitely some talk about, a better listing methodology of all these strikes that I just mentioned. If you're new to options and you open up a SPY montage, I guess it could be kind of intimidating with all the different strikes and all the different expirations. So, where do you begin trading? And it's something to have a tool like, a good advisor or ORATS to kind of walk you through that when you're shown literally hundreds and hundreds of different strikes. And the other good thing I took away was the whole that the OCC is working on the Renaissance system to help CMTA or the clearing member trade agreement. So I think, that's going to alleviate some of the problems with custodians not accepting trades from other brokers. And I think that's going to help the industry as a whole.
You're right. There was a lot of push towards that strike mitigation, and that may sound like it's deep in the weeds, listeners, and you may be coming to this saying, I don't know what the heck you guys are talking about. That's inside baseball, and you're correct to a degree, but these are things, like Chris mentioned, also permeate and ripple out to you guys in sometimes unforeseen ways. And, for example, for a long time, the industry had this mindset that more was better, more strikes, more quotes. Quotes were effectively advertising for the industry and for the business. So the more you had out there, the more advertising there was for options, the better it was for everyone. In recent years, we've realized, certainly as the number of firms providing liquidity out there has shrunk dramatically, that the onus to provide all these quotes, particularly on some of these thinly traded names, it wasn't really a value added to the business. It was more a risk to these firms, and it prevented them from perhaps being more aggressive on certain names and providing as much liquidity in the areas as they wanted, because they were focused on also mitigating their risk on some of these more esoteric names where, quite frankly, they're probably going to get run over more times than they're not out there. But they still were providing all these quotes and all these strikes going forward. So it does seem like there was a more impetus behind the strike mitigation than I've heard in the past. You're on board with that, Chris? Because it could kind of cut both ways. You're obviously out there also as a client, as an end user, looking for more strikes, but you also come from the market-making world, so I think you can maybe see both sides of it. So it sounds like you're on board with the idea of, let's say, reducing the number of extraneous strikes people have to quote out there?
I guess I'll start with, we don't need to add any more. I agree with you. For a time, we complained a lot, especially as market makers, that we wanted more and more strikes. And then I think we've gone all the way to the other end where we probably have too many strikes and you can still get what you need to get done with what's available right now. So I think the start really is, okay, let's stop now and let's reassess and see how it goes. But yeah, for me in most products, there's enough. If you don't have the open interest, if you don't have the liquidity, then I think we're just creating gaps and some hidden dangers in the marketplace. So I think we need to incentivize market makers to come back in, lessen the capital restrictions first of all, and maybe they can manage risk if there are less strikes a little bit better, and that would induce more volume, more liquidity, and then everybody gets what they want at the end.
Yeah, this is a scenario where maybe less can equate to more at the end of the day. Less having to display, having to show can translate into more liquidity. It sounds a little bit counterintuitive, but at the end of the day, it could indeed be. And this is a question that's been broached many times with the right approach to it. It seems like strike mitigation has more support behind it than some other alternatives I've heard over the years. Matt, same question for you. Are you down with this idea for strike mitigation? And any other interesting takeaways or things that resonate? You were on a panel at the event. Maybe some takeaways from your panel as well, sir.
Yeah, it was great to be down there. See you, Chris. My wife went down and hung out too. It was a lot of fun. So it's always good to see the people. It was neat to see people inducted into the Hall of Fame. I thought I
heard personally that was the worst session of them all, by the way. I heard the host for that session just booed out of the room. He was terrible.
There was a great host there, very entertaining. I got a chance to talk to Dan May and, of course, of MicroHedge. So it was a lot of fun to do that. MyX did a great job, John Smolin and crew. I was happy to represent the entrepreneurs in the option industry. It was the first time, 20 years of going that we were recognized. So I thought that was great. We were able to get up there and tell them, how much we're doing, how much you're doing on a day-to-day basis, and how important, these small companies that are out there risking their money and to serve and get people more educated, have better experience trading options. So that was neat to do, and I was able to actually voice some of my concerns up there. Eric Cott asked about some concerns, and I think that Chris eloquently pointed out some of the market maker capital restrictions, but I also think that just the market data fees, they're not very rational, incoherent, I would say, in a lot of ways. And, if you're going to get people to come in and trade, you want to invite them in with open arms, not shove a 20-page market data fee thing in front of an entrepreneur that's trying to to get the word out. So, I was able to voice that opinion, and hopefully some of the exchanges that were there, they got up, they didn't really mention that, but they got up and mentioned some interesting things up there. It was neat to see Shelley Brown talk about going to eighths and quarters again. That got a good laugh out of me. But yeah, I mean, I think those were the major takeaways, and like I said, it was fun to see you and talk to you on tape and in real life, Mark.
Yes, the double whammy there at the conference. If you want to check out Matt's panel for yourself or any of the other sessions, if you missed OIC, maybe you just missed a session, you want to check up on it, we have you covered. We have it all available exclusively on our network. If you go straight to our special events feed, it's all in there, as well as all the sessions from the SWAN, the recent SWAN Wealth Advisor Forum, all the panel sessions up there from that as well. So we've been attending a lot of events, so you guys don't have to, as well as talking to a lot of people in the industry. There's still more to come, if you can believe it or not. I've been talking to a lot of people lately, and it's all hitting the network. A lot of stuff hitting late recently from my sojourn into the crypto side recently, so stay tuned for that. A lot of fun stuff going on there. You could find it all wherever you find this fine program. Just a lot of it will be on the full network, or if you want specific, easy for me to say, specific conference content, then the special events feed is the place you want to go. Speaking of what's going on in the space and what's happening, a lot's been happening since the last time we all gathered here together to do an official show. Of course, we did the episode from the Swan Forum in Chicago last month, but it's been a couple of months since we've had a chance to get together and talk what's going on in the markets. And go figure, a lot has been happening in the world of options and volatility since the last time we all gathered here together. Ever since, particularly over the last month, we've kind of been trapped yet again, sucked back into this will they, won't they vortex of the trade war. It's on again, it's off again, it's on again, it's off again. And as a result, we've seen volatility fluctuating dramatically. We've seen the trade war is on again, volatility is on again, certainly at least as we're coming into showtime today. Most of the major indices selling off fully, about 1% here. We're seeing VIX cash surging yet again, threatening the 19 handle, right around 18.5 right now. And of course, our old friends like VXX and others back up over the 30 handle. So all of the many and sundry measures you could use to measure volatility in the space, all leaning back up to the upside, indicating not a lot of love, no joy going on here for the trading landscape, at least when it comes to the trade war. Maybe some joy if you're into the volatility side of the space. So Chris, let's start there. It's been a kind of a topsy-turvy time in the market since the last time you and I have chatted. Catch us up. What's been top of mind for you? What's it been like navigating these waters with the overlays and the puts and things as we're vacillating up and down 1% in the major indices, as VIX is vacillating between the low teens, threatening 20 again? What's it been like for you over the last month?
Well, we're certainly at the mercy of headline risks, that's for sure. So, I mean, in conjunction with, we had this huge rally in the first part of the year. So it was very important, especially for a lot of our products where, we do have hedges on, is to be cognizant of those levels and then take action with what the volatility and skew landscape gave us earlier in the year. So I can say this, that the VIX has definitely found a floor this year of about 12, unlike 2017, if we remember that year, where 12 was more resistance than support, and what we're seeing now. I am surprised that the volatility has not taken off as much as maybe we should expect. Maybe the sell-off will continue and speed up a little bit more as we break the 200-day moving average, which we're flirting with right around here, around 27.75 in the SPX. But again, it's really headline news. I think the bigger story is in the Skew index, where it's very depressed levels. If you look at the SIBO Skew index, it's in the 1 percentile over the last year. So that means a lot of people were prepared, had hedges on, and that's part of the monetization process, where people are, selling the puts that they were already long and getting ready for a subsequent rally. And that's kind of been the theme. I mean, we haven't seen any sell-offs that have really taken hold for a long period of time. I mean, Q4 of 2018 was probably the worst that we've seen in several years. But other than that, it's headline news and whatever the latest tweets come out.
Yeah, you're not the first person I've talked to recently who kind of thought maybe the move was a little bit underdone compared to what we were seeing in the broad market, at least the move in terms of a volatility in relation to the moves we're seeing in the broad market. Do you think, as these things tend to, as we start to get into this cycle of more headline news, you think, Chris, the market is just getting a little bit inured to this, and they're kind of like, oh, we've seen that, we've done that, a 1% move, not quite as shocking, and that's why we're not getting the dramatic moves in volatility as a result? You think maybe something else is afoot out there?
No, I absolutely think that. I mean, volatility, it gets crazy. The first time it has a new event, but then the second time it's already used to it. So it takes a little bit more to get it going. And I think we're kind of, as far as volatility is concerned, that's what we're feeling out. Just these sell-offs just haven't, there hasn't been any type of sign of capitulation. There hasn't really been any type of nervousness. I think the market's been trading more technically. Once we broke the 50-day, we did a logical stair step down to the 200-day, where we're at right now. If you want to look at certain formations, yeah, there probably could be a little bit more downside to 26.5, but that doesn't negate the overall bullish trend that we've been in. It's just finally a healthy pullback, if you will, kind of an organized pullback. Even though we're seeing some 1% days here and there, but I don't see the capitulation and everyone heading out to the exits like we witnessed with other past events, like back in February of 2018.
That's a good point about the Skew index. I haven't checked in on it a little bit. I'm looking at it right now, and you're right. It's at about a 112, which is, if you're not familiar with the Skew index, listeners, it's kind of a bit of an obtuse methodology they use to quote it. It's quoted in pretty much numbers from 100 to about 150. 100 is kind of on the low end. 150 means there's some tail risk. People are going a little bit crazy. Things are getting a little bit prepare. Look out below in the marketplace. And right now we're at a 112, which, given how much we've been moving down, I think it kind of speaks to Chris's points. People had hedges on. This is kind of a normal sell-off. People are taking them off as we go to lower levels. So things are kind of performing as you would expect. We're not seeing a massive spike in tail risk, which would maybe indicate that some other fears are afoot. Again, the Skew index is a bit of a it's an interesting beast. There's obviously two moving components to it, the call wing and the put wing. So when they kind of homogenize it together in one number, I think it's a little bit less useful, but still it's interesting, I should say, nonetheless, as to what's going on out there. Check it out for yourself. The ticker is just Skew. It's a worthy barometer to have out there. Same question for you, Matt. Kind of catch us up. What's been going on? I know you have a lot of different models out there that are predicting and analyzing what's going on. What's surprising you? What's perhaps not surprising you out there? And are you perhaps like Chris, maybe a little bit surprised that we're seeing, S&P Skew, aka the Skew index, as low as it is right now, given everything else we're seeing in the marketplace?
Yeah, all the Skews are screwed up. It's easy for me to say.
That's a good point. They are screwed up.
Yeah, starting with the treasuries, there's some inversion there. The VIX future, the term structure is pretty wacky. DEES being below Jan way out, and then it's pretty flat. And then, our contango measurement, I keep waiting for that. That's the best one that I like to look at. When that goes negative, that's trouble for the market. It's negative and starting to come back. So I'm getting a little bit more bullish on the market. But the slope percentile, we have a slope that we measure. It's akin to the Skew index in the that the SIBO puts out, but ours is at the 42 percentile. So it is definitely flattening out. And what I think is real interesting is usually when it flattens out, you get more of a smile. Now it's just a straight line across. So it looks like, I don't know, a crash test dummy that died. Is that a good metaphor there?
I like
no
that.
Smile, just what is that? What is it called when there's no smile and no frown? It's just straight across, whatever that is. That's flat, what I'm seeing.
Yes, just flat. I don't think there's any other word for it. Flat and or boring. Maybe you could describe it that way as well. I'm curious, Matt, for your methodology, because obviously SIBO takes this call wing and the put wing and kind of merges it together to get one number. Do you do something different, or do you maybe break out the call and put wing a little bit differently? Because sometimes the Skew number could change based on what's happening in the calls, all right? Not reflective in the puts, and that's hard to intuit from one number.
Yeah, so we do it much differently. We take the entire. Wow, this is a big question, but we take the entire chain and weight them more to the 50 delta. So as it goes out to the 20 deltas, but we line up the calls and puts should line up on the implied volatility. So all those strikes will line up, and we weight the smaller option more. But I've been doing this since I was, at a market making firm in the 90s on the floor. So we do quite a bit to get that slope number and look at it. We weight all the different months, all the expirations, and all that to come up with that figure. So what but it gets to a similar number that the SIBO does. It's kind of fun when it doesn't. They usually come our way eventually, but just one more of the numbers that ORATS cranks out here, and we've recently integrated it into our backtester. So it's neat to be able to see what option strategies work the best when the skew is the flattest, and vice versa. So that's quite a bit going on here, and quite a bit to look at. I wish I could test all these things, but we've been looking at so many things are going on with the VIX and with the skew and the spikes and all that. So there's a lot to look at, Mark.
You guys are certainly busy. Well, you mentioned VIX, you mentioned volatility and back testing, so I have to ask, Matt, a little birdie's been kind of perched on my shoulder, whispering to me that you've been doing a little bit of secret wetworks research over there, skunk works of ORATS, if you will, into VIX, and particularly VIX puts. That's kind of a sexy topic these days as volatility gets a little bit elevated, and then it comes right back off. The VIX puts getting a lot of love these days. I've heard whispers that you've been crunching some numbers over there. Any secret data, any secret findings you want to share with us? Remember, it's just me, you, and Chris talking. There's nobody else here, so it's just three guys in a virtual room talking, sir.
Oh, if it's just between us, yeah, I'll tell you the secret. No, I mean, I think it was Michael Coe said it. One of his friends gave him a picture, and he posted it. And it was my home state, New Hampshire, live free or die state. And the guy's license plate read VIX puts. So, of course, I had to go back test those. We have a new feature for our backtester that we're releasing soon. It's an optimizer, so I could put a bunch of different tests in, and it does all the parameters, so I could hone in on what maybe this guy is doing. It was a Mazda, so it wasn't like a Lamborghini or anything. So it looks like some of the best strategies in the VIX puts were long strategies, and it looks like. Especially if one of the things that we're able to do is what's the best strategy, but what's the best strategy when the VIX is at a certain level. So, if you look at it, putting the VIX above 17, for example, then the best strategy becomes like a 45-day, 50 delta put. So, relatively longer term, or I guess you call it medium term. At the money, the better sharps and Sortinos are out of the money. So all the way down to 20 delta is pretty good. But my guess is that guy is buying some puts when the VIX gets somewhat elevated, and then getting out when you make 200, 300% on your money are some good exit points. So that's what we're finding, Mark, in the thousands of back tests that we can now run within minutes.
Yeah, I saw that tweet you mentioned. So it sounds like that guy, he must have been happy with it. If you make your license plate VIX puts, and it probably worked out pretty well for you. I didn't see what car he was driving, but it sounds like he probably bought his car with some VIX puts. So it can work in your favor out there. Chris, I know you mostly play in the realm of the progenitor of VIX, aka the SPX, where of course the VIX is derived from. But I'm curious, given all the movements in volatility, have you been intrigued by perhaps maybe venturing into some of these vol products? And what do you think about the dramatic upsurge in interest in all things VIX puts these days, sir?
Well, we certainly look at it as a measurement. I mean, how can you not? So, I mean, we're definitely opportunistic when the VIX gets very low, and it gives us some opportunities to buy some, baby options, we call them. I think we all agree pretty much is to be net long units. And if we do get some sell-offs in the VIX and some low volatility periods, we're definitely not shy about going in there and picking up some extra units, which happened just a month or so ago when we were rallying to all-time highs. So you got to be opportunistic. I mean, I think in the long run, buying volatility is a difficult game, but there's definitely some opportunistic times when you can get in there and get cheap volatility.
Speaking of cheap or perhaps expensive volatility, it still is earnings season. You may not remember it because you're so just barraged and deluged by macro-oriented news, trade war this and trade war that. But it is still indeed earnings season, and the keepers of the earnings data, the earnings volatility data, of course, our friends over there at ORATS. Matt, we've been talking about this, you and I, for a while. We like to do it in earnings season because everyone and their mother likes to talk about earnings volatility during earnings season. And, it seems like for a long time, we've pretty much, and the data has backed this up, come down that there really isn't a right way or a wrong way to approach earnings. People always ask us, should I just blast away a premium during earnings or before announcements, et cetera, maybe buy it? And the data has always kind of been on both sides of the coin. You win more often probably with the selling, but the times that you lose, it wipes it all out and then some. So it ends up kind of being a wash at the end. But I know the last time you and I chatted a few weeks ago, it seems like the dark side was winning this cycle. Is that still the case? And any other surprising takeaways from this earnings season so far for you, sir?
Yeah, this hurts me to say because, back in the market making days, I always had to be long units. So, the sellers really got the better of the buyers this earnings season. We rarely see, I've never seen numbers this big. The selling win percentage is 70%, the buy win percentage, the converse to 30%. And the average profit was 1.3% per trade. So that's actually, it doesn't sound that high, but that is quite high. So that's as high as I've seen it as well. So, what it felt like to me was, we've had such high volatility levels going into earnings in the past few earnings cycles that they got there was a lot of movement, and now in this earnings cycle, we just haven't seen the big moves from the stocks on an overall aggregate basis. So the sellers really got the buyers this time, and it's difficult to. It's difficult to see any type of a trend. This was such a outlier earnings season. Other than, one of the main things that we look at is the shape of that of the overall kind of distribution. So, before I started doing this analysis, I said, okay, what do I think the distribution of the actual earnings moves look like? There's 4%. Implied in, let's say, for a particular stock. So it'll either go up 4% or down 4%. So I thought it would look like a barbell, but it actually looks like just a normal distribution that's flattened a little bit. And this one was a little steeper than usual, meaning more of these names are finishing, very close to no movement around earnings, which, the implied volatility versus the expected implied volatility after earnings is almost, in some cases, almost double. So it's almost 100%. It's more like 90%. But and when you get that, and then you get no movement, wow, you're obviously losing. They're taking a lot of that straddle price out. So, yeah, I think the main takeaway of this earnings season was, the look of the distribution, and basically just in the fact that buying that straddle, hurt some people, hurt the long gamma people, Mark.
Yeah, it does hurt to say that a little bit, right? Because you always come from the don't be net short units. Yet there is a large section of the audience that likes to live on the dark side, Matt. And they're always waiting for permission to blast away a premium. And like it or not, you just gave it to them, sir. So maybe be cautious out there. And we've said before, this is kind of a bit of an outlier. Usually the data does not line up on one side or the other, and we've all seen those moments a few cycles past where everyone was blowing through their straddles. Microsoft, Google, Amazon, all of them were kind of just going 2x, 3x, 4x, and that'll probably happen again next cycle, because if they're underperforming like this, they tend to tighten things up, and then next that leaves more room to blow through them again. So seller beware, I should say, when it comes to this. At the end of the day, we talk many times about strategies leading into the earnings event, coming out of it, maybe not riding through it. That's where the kind of rolling of the dice portion happens that you probably want to avoid. But we know there's an audience out there who likes to talk about this stuff. And so there you go, a little bit of data. Check out the rest over there, of course, in the land of ORATS. We have the reports on theoptioninsider.com, or get the premium stuff over there at ORATS.com. Let's keep on rolling. It seems like we can't go an episode, particularly now that we're coming up on election season here in the U.S. The 2020 election isn't as far away as it seems. And, of course, there's a huge field of candidates, particularly on the Democratic side, trying to outdo one another with who is more anti-markets, more anti-Wall Street. We have a lot of Elizabeth Warren, of course, made her bones out there. Bernie Sanders not wanting to be outdone now is the latest Democratic contender to announce he's going to try to impose a transaction tax. And he's had something like this. He's been bandying it about since his last run, really, but he's putting more teeth to it this time in terms of actual specifics. The plan he's promoting, he offered it, just announced it, I think last Wednesday. He wants to apply a 0.5% tax to any stock trades. Think about it, everyone talks in basis points all the time, and you're going to get a 0.5% clipped off the top, 50 basis points for every stock trade, 0.1% for bond trades, and 0.005% for any derivatives transactions. How they arrived at these numbers, I honestly have no idea. According to them, this tax would provide both a disincentive for high-frequency trading based on algorithms and also let Wall Street help middle-income Americans who helped foot the bill for the bailout of financial institutions after the 2008 market crash. It's time for Wall Street to pay society back for the incredible damage it did and continues to do to the middle class of this country. He says this transaction cash could offset the revenues for his tuition-free college plan and help pare down student debt. It seems like we have to discuss this more frequently now on the show. It's kind of a bit of a shame. Every now and again, the specter of a transaction tax raises its head. Senior heads usually seem to prevail at the end of the day, and it never really passes committee. It could be the same with this, but now that we are in the bit of an election season, everyone's trying to outdo themselves to appeal to one constituency or another. So these could have a little bit more legs to them. This one actually specifically mentions a percentage for derivatives, which is a first in some time. But it's kind of interesting. Chris, maybe you could see how it sounds good. The rhetoric on the surface, of course, hey, we want to tax these fat cats and all that money is going to go to help kids go to college. It sounds great on the surface, right? People, until you start actually digging into the numbers and people realize that these taxes never really work out the way they plan, do they, Chris?
No, first of all, they don't work out, like you said, but the other, taking the approach from the liquidity standpoint is, what's this going to do to liquidity where we already have a fragile market out there? And is this really going to help the situation, or is this going to actually increase volatility? I think most people would say, well, let's get the HFTs out of the equation. That means volatility will decline. But will it really? I mean, we don't know what the actual effects could be by, imposing an extra tax. I think initially, or not initially, but you definitely will see people stop trading in certain products. And that's what we're all here trying to get more liquidity, more volume, and concentrate, put some of this concentration that we see in some products over, and kind of, I guess, spread the love is what I'm trying to say here, is like, let's shore up where we don't have liquidity in certain products. And I think that is what's going to drum up more volume for the industry. And I don't think any type of tax, whether it's for stock, bonds, or any type of derivative, is going to help that.
Yeah, we just spent the first part of the show talking about how we can incentivize more liquidity in the space. And, people who propose these taxes usually, depending on, I don't care what side of the aisle you fall on, listeners, whether you agree with the spirit or not or whatever, that doesn't really matter. At the end of the day, people who propose these usually have a very limited knowledge of how markets actually work, and that they tend to do very basic math and say, oh, X% per transaction multiplied times the number of transactions will translate to Y amount of revenue and these taxes never work the way they're planned, whether it's on transactions, whether it's on soda, I don't care what it is. Taxes have an impact on the space. In this case, they will reduce the number of transactions. They will widen out markets. They will reduce liquidity. And so the revenue that's planned never actually translates to what's expected, and the impact and the damage as a result is far-reaching. So there are many, much less harmful, much better ways to go about some of these plans than this. But we seem like we talk about these every now and then, but they're coming up hot and heavy these days, so we have to at least address it. And of course, for this audience, spreads and liquidity, and then of course the tax side, the tax consequences therein are big for this audience. So unfortunately, it seems like that's back on the burner, at least for the time being, as we head on into full-blown election season here into the U.S. Meanwhile, on the show, though, it's been a while since we had all had a chance to really gather here together to answer some of your questions. So let's do some of that now. Let's hang out a shingle. It is time to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Welcome to the office hours. This is where we get a chance to answer your questions. We got a lot of them across a lot of different topics. Some of these are pretty pretty epic. Let's start with this one here. Let's go down to, we're just talking about volatility. So here's a question from Brandon JT. He wants to know, do you think the rash of share buybacks these past few years could be contributing to the volatility in the marketplace? And he includes a chart. I don't know where this is from here. It looks like some research firm. And it shows that the total number of shares outstanding in the S&P and how it has dramatic. It's far lower than its height. Its peak was around 2010, 2011 in this graph. And we're right now at, looks like roughly about a third of that here on this graph in terms of total shares outstanding for the S&P 500. So that is an interesting point. There has been a rash of buybacks. Some people have said that that's been artificially inflating the valuations in the space as a result, as these firms are continuing to support their stock prices. And also maybe the fact that there's fewer shares outstanding could be perhaps translating into this. Oh, he adds an addendum to this. He says, or maybe it's just this other nonsense. And he includes a second chart here, which is, this guy's got all sorts of visuals here. I like this. We'll have to include these in the show notes for you listeners. He says a second chart, which shows that this is a list of IPOs here over the years. And it says a record high 81% of companies going public in 2018 via IPO had actual negative earnings. Which is, according to this chart at least, looks like at or around or even maybe higher than the levels we saw back in the go-go.com 98, 99, 2000 levels. So a lot of food for thought here in terms of our share buybacks causing volatility. Maybe the fact that, I wouldn't say garbage companies, but companies with weaker balance sheets are going public. Could be a little bit of all of the above. Maybe, I don't know, Matt, a lot to dig into here. Maybe we'll start with you. Do you think, maybe we'll start with the more quantifiable, the share buybacks. Think that has anything to do with volatility? And then maybe the latter, just the fact that they're not making money, sir. Maybe that's causing vol.
Yeah, I'm not sure about the buybacks, but there are fewer and fewer stocks and more ETFs. And it seems like there's just more risk out there. There's more, correlation, and when things start to go south, they start to go south fast. That's what it's feeling like to me, at least when the market goes down. And then, like Chris was saying, there's so much headline risk now. But then I also heard there's a Trump put at 4% under the market. Someone was talking about. So I think that is interesting, but it was a very volatile year. I think I think what's causing it in effect is, when you don't have much volatility and you have, the market going up, people are chasing returns, and the only returns that you're getting anything was a short vol. And when you have that many people short vol, and then the market goes against them, they all run for the exits at the same time. So I think it's more of a, we haven't had a lot of shakeout lately. There hasn't, been a recession. There hasn't been a lot of volatility. So when you get the volatility, it really, I guess, is exacerbated by the fact that it hasn't been there in a while, Mark.
Yeah. I mean, on the surface, you could probably see how some people might intuit that, less float could cause more rapid swings in the marketplace, and maybe there is a little bit of something to that. I haven't really crunched that particular number to see for myself. I don't think there really is. I'm kind of with you, Matt, but there may be something interesting to that. So maybe Chris, what are your thoughts on the notion of buybacks and maybe their impact on volatility? And then C, I think that he's kind of joking, but maybe still kind of serious issue that the companies that are going public are also of, shall we say, a diminished quality compared to years past.
Yeah, I think the buybacks could definitely be an ingredient, and I say that because it just leads to market movement, and there are a lot of different other factors out there, a lot of different other strategies such as risk control, risk parity. And in a nutshell, if markets are rallying and you have a low volatility environment, they have to put risk on, right? So they have to go, like Matt said, go short volatility by synthetically buying equities. And then once the show starts to get a little juicier to the upside, well, the CMTAs and the momentum players jump on board, and then you've got the noise during the day from the high frequency traders. So all that ingredients, all that mix, creates this potential combustible product, which we interpreted as volatility. And so it can go the other way. If markets are going down, then you have the risk control and the risk parity firms doing the opposite. They have to de-risk, meaning they're short gamma, right? They have to sell as markets are going down, or buy, like a previous said, buy when markets are going up. So I do think that, I'm not going to say that buybacks are a sole part of this, but I definitely think they're one of the ingredients, part of this mix that we have to contend with. And as far as the IPOs are concerned, I mean, it's a fact that, the quality of an IPO is getting less. First of all, there's less and less IPOs out there compared to what it used to be, because there's just less investment banks. So, you used to have 15, 20 underwriters on an IPO 10, 15 years ago. Now you may only have 5 underwriters. So 5 underwriters can kind of control the IPO a little bit more so that it benefits them. And I'm not accusing anything of anything. It's just the fact that you've got less players. So the pricing of an IPO nowadays is not as stringent as it used to be 10, 15 years ago.
Yes, certainly a lot of play in those IPO prices out there. Speaking of prices, let's keep rolling. You guys got so many and varied questions. I love it. Let's next up, Alex G wants to know. Good question, actually. Have you guys ever done a show about strategies and positions to utilize with ESOPs, aka obviously employee stock option programs? He says, if not, do you have any recommendations? Thanks. That's a good question. We have not in the long history of our network, over a decade, 12 years now. We've never really done an episode kind of exploring these stock options programs for a couple of reasons. First off, they were kind of hot and heavy when Options Insider first launched back in 2007. We saw a lot of particularly tech-oriented firms compensating their employees with stock options programs. We saw Sarbanes-Oxley and other regulations come along, and as a result, that kind of fell by the wayside a bit, as all of a sudden, go figure, firms had to actually account for those expenses, and suddenly they were not as popular as they used to be. So they became a little less popular. And also, we like to talk mostly about standardized kind of listed options here and the strategies you guys can utilize with those. And quite frankly, a lot of these ESOPs use non-standard, if they're going out there and just buying, 2-year out Apple D's puts, yeah, we could talk about that, or giving you calls on that level, maybe along those lines. But a lot of these contracts, let's say you start whatever your employment date is, they may give you 5 years out from that date, maybe some sort of really custom end of month contract that expires 5 years from that date with a strike at a certain maybe strange mid-level strike price. And it's something that's not really that easily or readily fungible with a listed contract. So as a result, we haven't really approached it. But it is an interesting idea. I know there are a lot of our audience out there, particularly, let's say, and for this show, I know we get a lot of audience in the San Jose area. It has a lot of concentrated wealth in certain tech names. So there may be something interesting to perhaps explore there. I don't know, Matt, I mean, is this... I'm sure you probably have been approached with this in the past. It probably is something you guys can do. It'll take just a little bit of tweaking of your models. Have you guys ever had to do this, like back testing or doing analysis on some of these custom positions people get through these ESOPs?
Yeah, when you said these employee stock ownership plans, it ran shivers down my spine. I did a big paper on it in graduate school, Mark. So I'm trying to get my bearings back here.
How did I know you were the guy to ask about this?
Yeah, and I don't tell, if it's just between us. I was a CPA way back in the day for a firm, and we dealt with a lot of derivative firms. So yeah, I mean, there's so many things with an ESOP. I saw one article, the Swiss Army knife of liquidity strategies. There's tax benefits. There are exit without selling to a competitors, and transitions and incentives, and there's so much going into it. But the pricing, the optionality and the pricing, they like to look at the listed markets, and we have helped expert witness preparation and such for these type of valuations. But it's an interesting question, and the back tests, we'll often do against similar stocks. Often the stocks that we're looking at don't even trade options, and so we'll have to look at similar debt to equity ratios and such, and present a mixture of stocks and try to predict what the pricing might be for those lucky few who have in the money options or valuable options. Pricing them is tricky. The strikes are sometimes creative. The expirations sometimes creative as well, Mark.
Yeah, it's not standard, and that makes it kind of interesting on one hand, and also, as you mentioned, challenging. We like things that line up easily with an expiration calendar, and everyone can access them, and they're fungible with the listed markets. And now all of a sudden you got some non-standard date, some non-standard strike price, and maybe the contract specs are even different. Maybe it's not standard 100, maybe it's something else. So there's a lot of different ways that these ESOPs could be not exactly easily or readily fungible with the listed markets, which is why we haven't done. But maybe that's a good reason to do a show about something like this. It's something that's always lingered in the back of my mind. Maybe something that's worth exploring, and maybe Alex G's email will plant a seed. We'll see. But it's an interesting area, and I'll just say this: I think it's probably worth some further exploration here on the show. Speaking of going further, we're coming up against. I think we got time. We got time for one more. Sure. Let's go here to. I like this handle. That's why he gets on the show. Melt Zone. I don't know, maybe he likes a nice cheese melt. I don't know. Either way, I like it. He writes in, or perhaps she, seems like the Morningstar options-based funds category has been pretty static since it was launched. Have you seen any updates or changes worthy of note? Can we expect any? And I was just talking about this with someone this morning, actually. It is an issue of some consternation in the space. The fact that they kind of launched this category through everything options oriented within it and haven't really managed or seemed interested in updating it pretty much ever since. It's kind of like here's the kitchen sink, and go forth and enjoy. Some interesting data on this segment. I was kind of looking at it myself after this question came in. They said they had big inflows in that category, nearly $2 billion. Just in the last few years alone. Also interesting to note, a large portion of these. It's also the fifth largest category for what they rank as of the end of January of this year in terms of the assets they put in this. I guess fifth largest category, and I guess I should say in the alts category. So that's kind of a little bit of being like the tallest guy in a short kids camp, but still interestingly enough. Also interesting, I think interesting for you guys over there at Swan too, because you guys at Swan has obviously been doing this for a long time, but you guys are kind of alone in that. I'm looking here at the numbers here from the options-based category. They say nearly 1/4, so there's about 89 funds in here. 21 of them were added just last year, so added in 2018, and 6 out of the 10 funds have performance records of less than 4 years. So that just kind of shows you how nascent a large portion, a large swath of the options-oriented fund category is. And B, Chris, it's one of the reasons you guys are on the show. You guys have been doing this for a while, so you have a little bit of a track record here to fall back on. But this is obviously a point of consternation with you guys over there at Swan as well, kind of getting lumped together with everyone else in the space. What are your thoughts on perhaps the evolution or perhaps the lack thereof of the Morningstar options-based category over there, sir?
Yeah, it's a great question. I mean, we were one of the ones trying to push for an options-based category out there. It was necessary in the 40 Act fund space. So, you've already mentioned a lot of great points here, and a lot of new funds have come on the scene. Part because of this show and all the education at the exchanges and the ability to backtest through ORATs and all these things. So it's great for our industry. We're kind of like, we're not as old as some of maybe the other option strategies out there, but we've definitely been around relative to a lot of the new ones that have listed, especially in the last year or 2 years. So, I think we still agree that it's great that we have this category out there, but they could probably do a little bit more refinement and dividing it out The three basic categories are income strategies, hedging strategies, and then your alpha/tactical trading strategies. So, maybe they need some more funds out there and maybe a few more years on how to analyze, where exactly each fund falls into, so that they can actually kind of categorize, have some subcategories of the option space. But it's not perfect, but at least it's there, and over time, we'll get it to where we need to get it as far as the options and mutual funds are concerned.
Matt, same question for you. Obviously, this is a hot topic in this portion of the space, the advisor-oriented side of the option space. It's nice that it exists, but as Chris mentioned, it could certainly do with some improvements. What do you think Morningstar should be doing to make the options-based category a little bit more relevant?
Well, I was just reading my friend Joe Cusick of the OCC now moved over to Calamos Investments. They wrote a good blog post on the option-based funds category.
Oh, was that Joe's research there? I don't know who put that. That was Joe?
Well, I don't know if it was his research. I know he's there. I'm talking to him pretty soon here. But they're saying that it's the fastest growing liquid alternatives category in the last 2 years. In December, 1.8 billion flowed into the category. So, we have some critiques, but it looks like just based on the numbers coming in, and looks like they're growing pretty good. If you look at the chart, just off, it's hockey sticking right now. So that's pretty interesting, Mark.
Yeah, it's nice to certainly have growth, and you're right. It's good that it existed. I know a lot of people cheered when Morningstar really kind of reinitiated its options coverage a few years ago, but they kind of just did it and kind of just let it sit. And they haven't really, what Chris pointed out, that's a very basic thing they could do. These strategies don't at all belong in the same bucket. If you're buying puts just to hedge against long equity, that has nothing to do with alpha generation. That has nothing to do with generating income. Those should be at the very least 3 separate buckets. And then you could argue probably you can go further down the rabbit hole, but let's just start there and make our lives easier with comparing and contrasting strategies. If you're buying puts, it's going to be a drag on your portfolio. So that should not be in there with income. That should not be in there with alpha and vice versa. They all have different goals and different methods of operation, different rules of engagement. So lumping them in all together probably isn't the best thing for anybody in the space. And unfortunately, that music means we're done. I wish we could keep going for many hours, listeners, but we are out of time. But before we go, let me go back around the horn, checking with each of my cohorts here, my partners in crime on the old show, see what they have cooking that may interest you. Let's start with you, Chris. I know you guys are just off the heels of your big Swan Forum, so you're probably kicking back, taking a nice, relaxing, well-deserved break. But I was there. It was pretty crowded. It seems like there's a strong demand for what you guys are doing. And I'm hearing whispers and rumors about another event coming up. Has anything been solidified on that? And if people want to learn more, where should they go, sir?
Well, we are definitely talking about putting a fall event, but we had a great turnout. Every seat was taken, so it's a good thing that Matt didn't show up because he would have had to stand the whole time. But we
didn't want him there anyway, really. I mean, come on.
Yeah, he went to Miami a couple of days earlier. Who would have wanted to not go to Chicago? But I understand. But you know what? Even after all the hard work that everybody did to put that on, and it was a great event, we do have a couple of new pieces out on our website. One is called 10 Years of Bull. It talks about how the last 10 years have been a dream for long investors, while the 10 years before that was a nightmare, and how the defined risk strategy provided consistent results in both of those environments. And then there's another article called Harnessing the Power of Rule of 72, and that just kind of gives some insights about how the DRS has consistently built investors' wealth by harnessing that power of 72 with less volatility and risk. And you can find all that at our website, swanglobalinvestments.com.
And Chris, I'm sure you saw, but OIC next year in your neck of the woods in Puerto Rico, right down the street from you guys.
Did.
So
I can't believe I just forgot about that, but that's going to be right up the street from where we live. So I'm looking forward to that. And
you could walk to OIC. How nice would that be?
I guess I could if I took a day or so walking. I may be a little tired.
Maybe not that close.
But it's definitely right around the corner, and I look forward to it. So maybe Matt will actually show up and visit us down here.
Uh-oh, Matt. Matt, the gauntlet is thrown, sir. But, I mentioned at the top of the show, Matt, I'm hearing whispers. I'm hearing rumors about all sorts of cool stuff coming from your neck of the woods, the new options mecca known as New Hampshire. I know a lot of it's still secret, can't be released to the public yet, but what can you share with us, sir, about what you're working on?
Yeah, we mentioned a little bit on the show, but using the indicators, volatility indicators, to drive option strategy, rule-based strategies, we get a lot of requests for that, and we're coming out with that. And people using technical indicators, and so we're going to integrate that a lot more over the coming weeks here. And we have a big something I've been dreaming about for a long time is this optimizer, where I could throw thousands, if not millions, of tests at our back tester and get all the results. And then we have ways then go in and confirm that the back test works out of sample, and there are ways to do that. So there's just a ton of things coming our way. And Chris, that I'm down there anytime you need me, and I have been probably to his office more times than any of his other friends down there. So I love it down in Puerto Rico. I'm excited that the OIC is going to be down there, and they need it, and it's great. We have clients down there in Puerto Rico, and it's a great place to visit, and love seeing Chris and the Swan folks down there as well. I'm just looking for invitations, Chris.
You're just looking. I think you like that cigar room in the basement there of the Hotel Coronado or whatever over there. It's whatever it's called, Condado, I think is. That was a great, wherever you had that event a few years ago, the Swan event. That had a great cigar bar downstairs. So check it out if you're in San Juan, listeners. Meanwhile, of course, check out what Matt and his team are working on. At least the stuff they can reveal right now over there at ORATS, and give them a follow on Twitter at optionrats.com. While you're at it, and of course, Chris and the team at Swan Global Investments on the website side, and at Swan Global on all of the various social medias. And of course, he's traveling hither and yon. I did get a chance to catch up with him down in Miami. Good old Eric Cott and his growing team over there handling the OIC's advisor outreach. Check it all out for yourselves. Optionseducation.org. Click on the advisor tab, and you're off to the races. And hopefully you've had a chance to check out his brand new show on my network. That's why he's not here. He's too busy doing his own show. The guy's getting too big for us over there. It's called Coffee with Cott. If you like this show, you're going to love that one. Hopefully you've checked it out if you haven't already. And on behalf of Eric, let's give him a free plug, why not? And Chris and Matt, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in so many great questions. Keep them coming. And we'll see you back here next time for more of The Advisor's Option.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets. offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity, with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com, or visit northerntrust.com/capital markets.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.